This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The party's still going, but the hostess is looking tired. And on this week's show, we'll talk about why it may be time to start looking for our coats and get ready to leave. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. This is not a perfect analogy, and while talking to clients recently, they told me that what I'm about to describe was actually kind of featured on an episode of something called Friends and Neighbors, which I've never seen. But I've been thinking about the markets as like a party recently. And as it approaches midnight, and everybody's been having a great time. Now, it doesn't mean it comes to an end at midnight, but a lot of folks are starting to leave, and you have to decide if it's best to call it a night or if you're going to stay with those that are going to keep it going into the wee hours, which often doesn't end well. I'm really not trying to suggest that we're racing towards a cliff here. Don't let that be your takeaway from my sentiment. But as the markets continue to climb this wall of worry, as the data suggests there could be challenges, as companies that are doing very well and evidence is that they're going to continue to do well, you don't have to leave the party in this case, but you think about if you should keep pushing the throttle to, I guess now mix the metaphor, keep allocating more to the aggressive growth that has been so rewarding these last few years and maybe keep adding more, or maybe you should back away a bit. Keep skin in the game, but not be fully leveraged to the thesis that this is not going to end anytime soon. It might not end. And if you've pulled back, if you've reduced your allocation to risk there, you'll still participate with what you left in there, but risk not earning every dollar that you could have. Maybe you'll regret not having been fully leveraged to that, but you'll still be outperforming what your stated goals probably were a few years ago on an average basis versus being left at the party kind of well past midnight when maybe it does all go south and you're exposed to downside risks that give back too much of these above average rewards that we've been enjoying these last few years. And to be sure, I've said it on shows recently, you can argue that the markets are cheaper today than they've been in recent years because earnings growth has exceeded expectations and many names are pushing onto new highs. They're trading actually at lower forward valuations than where those same stocks were trading at, we thought, a couple of years ago. But if those expectations do eventually hit a bump, don't be left wondering, well, why did you have so much at stake within them to begin with? And also, this is on the contrarian side, there is a lot of liquidity out there. There's an estimated $8 trillion on the sidelines in cash and cash alternatives for investors today, compared with about $4 trillion in the period before years before COVID. And this is according to data from the St. Louis Fed. But while that is a high number measured in terms of dollars, actually it's not very high as a percentage of investors' total assets. It's at slightly less than 4% in cash today, where according to the study, 4% is roughly neutral, according to that St. Louis Fed, and anything above 4% would reflect a lot of liquidity. So we're a little bit below neutral now. In fact, they point out that the equity exposure is near all-time allocation highs, while cash holdings represent money that has not come out of stocks recently, but instead really where the liquidity is, it's money that's flowed out of bonds. So it may or may not be kinetic energy that can fuel further equity growth just from inflows of capital, or it might find its way back into safer assets one day. It would be a major sea change for the money to come out of bonds and eventually find their way even into more equities. And what about this economic backdrop that's driving all of this? On Thursday this week, we actually got thankfully, some inflation data that wasn't too bad in the form of the PCE reading. It was actually a bit below the expectations, albeit not particularly low, where we had a 3.3% annual rate on the core reading. We know the core reading is without food and fuel, blah, blah. Anyway, 3.3% annual rate of inflation. but only 0.24% on the month-over-month inflation rate. So if you annualize that, it'd be a lot more modest, versus the FactSet stated estimates for the month-over-month, which was 0.3%. So the inflation reading, for what it's worth, was a little bit more benign. On the other hand, we got the second revision, the second of many revision for the first quarter GDP reading, which is that the GDP in the United States grew at 2.6% year over year in the first quarter and 1.6% quarter over quarter versus the estimates which were looking for a 2% rate of growth. Markets did not love that. If you recall, the initial readings back at the end of April was that the first quarter GDP growth was 2% for the quarter over quarter, 2.7% year over year, and that reflected that half of the GDP growth that was stated then was from AI development. So we got 2.7%, 2% for the quarter, but half of that was from AI development. And while AI spending has not slowed, these lower revisions are actually maybe reflecting that the rest of the economy is growing at maybe 0.5% for the quarter and maybe not leaving a lot of room above that flat level or ultimately successive quarters, blah, 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 whatever your various definitions of recession might be. Albeit this isn't a leading indicator, but it's not necessarily an encouraging trend here. And while we recently got a new Fed chair and one who's expected to be dovish and lean towards rate cuts going forward, the market has now priced in that the baseline assumption is that the next move is going to be a rate hike, and one that's going to occur in the fourth quarter this year, with previous inflation indications before this one on Thursday, as well as this daily vacillation between the war with Iran and the subsequent higher energy costs coming to a close, and then maybe not coming to a close. They're coming to a close or dragging on longer, whipsawing us back and forth, and the price of oil back and forth, seemingly now really multiple times in a single day. And in a speech last week, one Fed governor, Chris Waller, who's been typically known as himself being pretty dovish, he seemed to pivot from that stance as he said, quote, "Inflation is not headed in the right direction," end quote. And then he went on to say, quote, "I would support removing the easing bias language in our policy statement to make it clear that a rate cut is no more likely in the future than a rate increase," end quote. And in similar fashion, Minneapolis Fed President Neil Kashkari said this week that his focus is more on inflation than on employment. Specifically, quote, "I am focusing heavily on inflation, not ignoring at all the labor market. We need to pay attention to both sides, but the labor market is in decent shape right now, while inflation is simply much too high," end quote. And this comes at a time where, while the PCE data was seemingly somewhat benign, personal household incomes were disappointing, as that was shown on Thursday for the month of April to be actually completely flat for the month, meaning households are now seeing real incomes adjusted for inflation negative growth, which correlates with the consumer confidence readings we've been getting lately, which are basically the lowest readings in many, many years. One bit that is actually helping the overall economy for now, though, is that consumer and corporate borrowing hasn't become terribly more expensive. You've seen benchmark interest rates and bond yields have begun to trend higher in reaction to all this recent data. But the prime rate and the SOFR rate, which is, I'll stop saying this eventually after a few years, but the SOFR rate is what we kind of used to call LIBOR. They've both remained near their 52-week lows and well below where they were just a few years ago. 30-year mortgages have started to rise a little bit, unfortunately, with the average, according to the Wall Street Journal, now at 6.64%, up from a recent low of 6.1%. But it's still down quite a lot from the 52-week high, which was still 7%, and before that, somewhat higher than that. But today, the SOFR rate is 3.55%, the 52-week low is 3.5%, and the prime rate is 6.75%, which is right at its 52-week low. And both are often used as the base rate in many floating rate loans that consumers use for borrowing and more so corporations use for borrowing. And while the long end of the curve has started to move, and by the way, if the long end of the curve rises, yields go up, and the short yields end of the curve, the short maturities don't, that's often a good sign for the banks and insurance companies. But anyway, if the short end does start to rise, though, and starts to squeeze out some of this lending with those two rates going higher, then we might see some bigger issues creeping up. Through April, durable good orders remained very strong, which is maybe reflected both the demand in the economy, the expansion of businesses, the affordability of lending as described by those rates. They might be inflated somewhat because AI spending finds its way in there, but it also has a big boost this year from accelerated depreciation allowances, which were part of what was passed in the big, beautiful bill. And if these rates, if SOFR and the prime rate do start to move higher, well, that could be a hit to that durable goods spending and an area of spending that's already been probably front-loaded to the first part of this year. So there are quite a few signs that the economy right now might have some challenges ahead, especially if you exclude the effects of AI. Otherwise, the overall economy is not doing a heck of a lot today. And with that cheery note, I'm going to take a quick break here. But when I return, I'm going to share some reports from two of the leading banks in the country with their updated expectations for the markets for the rest of the year, as well as one's asset class return assumptions for the next 10 years. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Violent stock market rotation, growing divide between winners and losers, and AI disruption fears. But might one man's trash be another's treasure, with opportunities emerging amid the churn? Tune in every week as we discuss the latest financial trends and what investors need to know to learn where to find value in a frenetic market and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Before I dive into those two reports I mentioned, I want to point out a Wall Street Journal article from Monday titled, "The Risk Premium for Holding Stocks Over Bonds is Vanishing." Now, that article was printed during a week where, so far for the year, the S&P 500 as of today has returned about 10%, but the Bloomberg Aggregate Bond Index returned 0.0% for the year. That includes the income the bonds provide. Interest rates went up, bonds values went down. So in the face of that, they printed this article. And it doesn't mean that stocks won't go up or maybe go up more than bonds, but it's a measure of the yield that earnings represent on stocks versus the yield on a 10-year Treasury bond. That's how they calculate the risk premium. And according to our article, that spread, the risk premium that you're getting for equities, the yield between the two, hasn't been this low in over 25 years. And I'm not going to spend a ton of time on this because it really could be thought of more as a trading tool if you were going to make major allocation shifts over short periods of time because you thought bonds were cheap relative to stocks and you were really going to radically turn that apple cart over just for a few weeks or so. That's not what we do here. But it reflects that bonds have struggled because yields have risen, driven higher by inflation fears and, of course, spurred on by the war with Iran. And the earnings yield on stocks doesn't include so much of what's being packed in for future earnings looking further out on the horizon, which Wall Street is certainly banking on, quite literally, that will come from all this AI spending. Although the equation does account for future earnings in the next 12 months. It is using forward estimates. Those are projections which I pointed out recently. The forward estimates, at least so far, proven to be too low for a change. And estimates on many corporate earnings right now are quickly being ratcheted higher, which would be the argument that this measure, this risk premium measure, is not that useful for today. But it's worth noting as it's affecting some estimates for how much you're getting paid or not getting paid for taking on the additional risk of owning equities versus, in this case, a 10-year Treasury bond. First off, as far as the other reports, I'm going to draw from Goldman Sachs, in which they issued a report which revised their end-of-the-year target for the S&P 500 up to 8,000 now versus their previous estimate, which was 7,600. And if we got to 8,000, that would be about a 6% return over where we are today. And they gave a 12-month target of 8,300, or roughly 10% higher than the market is today. And that's not bad. It's higher than you'd get probably on a bond return today when you think of it in terms of risk premium. But of course, it's not assured, and Goldman Sachs offers that they weren't saying this as a bullish note, but saying that they expect instead modest returns with a front-loaded market rally. That's what we've been experiencing, already reflecting in these prices today. They also cautioned that in 2027, they, quote, expect growth to slow materially, end quote, from 24% earnings growth this year to 13% earnings growth next year. And again, maybe we'll follow the recent pattern of these firms having to ratchet up those future expectations, that 13% expectation is too low. But it does lead one to question valuations a bit right now. And the crux of their thesis is that AI spending is still expected to increase, with CapEx from the hyperscalers next year to be over $900 billion versus about $750 billion this year. But there's a big need for them to start demonstrating a return on that investment soon, as I recently pointed out in a podcast where I contrasted the quarterly reports of a few of these notable hyperscalers and how some are delivering returns and some are not. Goldman says that the market is overweighting the value of the near-term earnings results, and there's too much uncertainty on who and what the long-term AI winners will be. Their bottom line is that they expect more moderate gains in equities with increasing volatility. Meanwhile, over at JP Morgan about a week ago, they published their long-term strategy thesis, summarizing what they expect the various asset classes to return over the next 10 years, which is no small feat with so much headline volatility and political volatility and the AI revolution and so on. But I'm going to try to be pretty succinct with it because I'm not going to get into some of the asset classes they mention and go into the whole report. But to start with the bottom line, using what they say is their assumptions on their internal rates of return of the different asset classes on an annualized basis, they expect investments in Treasury bonds to return 3.6% a year for the next 10 years. Investments in investment-grade bonds yield 4.6% a year. Investments in stocks to return 6.9%. And real estate investments to return 8.7% a year, with some other asset classes which, as I mentioned, I'm leaving out. The primary takeaway of the piece is, if they are correct, is that relative to other periods, all of these asset class returns are relatively moderate, not exceptional. They don't say one is going to outpace where it would have been in any other period of time. They say that equity returns are constrained by valuations today, which limited the gains one might receive from multiple expansion. And we can reflect on what stocks did between the years 2000 and 2010 for perspective on this, while saying, again, that this or any of these reports I talk about aren't a baseline. But if you want to err on the side of caution, it's good to reflect on the conservative assumptions. And in that decade, we were in the middle of it a quarter century ago, the S&P 500 for those 10 years returned 0% on average per year. But there were superior returns to be made within that decade for some investors who were mindful of valuations on what they were buying, who weren't all in on the hottest items at the peak of the market that led into that period, and who enhanced their returns over time by putting a greater emphasis on dividends to give you something above just what the market growth would do. If we are going to still endure a period of somewhat higher inflation, then you're going to have to grab an oar right now and row if you want to see a sustainable real return. But while there's a lot yet to be answered, and how many of these stories end and what the AI story means in 5 and 10 years. If maybe it's getting a little late instead at the party right now, while we don't want to get up and leave, let's mix this analogy in again. You can at least say, let's set aside some of the fear of missing out and instead start focusing on risk exposure and looking at real personal returns rather than chasing headlines and benchmarks. So you don't got to leave the party, but at least figure out where your coat is lying and pick it up. Now, that's my story for this week. For the Wise Investor Show, I'm Chase Hinderstein. All I have left to say is go New York, go. Let's go Knicks.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.